Hello and welcome to AI Market News by LM. Before we jump in, a quick disclaimer. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Okay, let's get into it.
Welcome to the Deep Dive. We gather the market chaos, stack the sources, and give you the essential knowledge you need. Today, Friday, September 26, 2025, we are really witnessing a genuine collision. It slammed the brakes on the prevailing market narrative. We've got two massive pressures hitting all at once. First, unbelievably resilient U.S. economic data that's forced a harsh, instantaneous recalculation of Fed rate cut bets. And second, a sudden, massive new wave of protectionist tariffs. These threaten to upend global supply chains, maybe even overnight.
Yeah, that collision, as we see across the prepared resources, it's the absolute definition of high uncertainty right now. You see it everywhere. Volatile treasury yields, bond prices all over the place, and really divergent sector movements in equities. Traders just aren't sure. Is the main risk recession and slowing growth, or is it inflation heating up again, fueled by, domestic policy?
Yeah.
And that fundamental conflict that's driving the entire system right now.
Okay, let's try and unpack this dramatic shift. We really have to start with the economy, don't we? I mean, for months, the market was banking on a gradual weakening of the U.S. economy to justify, huge rate cuts. So why is the underlying U.S. economy looking so robust right now? And why is this good news suddenly translating into selling pressure for stocks?
Well, the U.S. economy is just proving remarkably stubborn against all the Fed's tightening efforts. It really is. The whole rationale for aggressive monetary easing has just kind of evaporated this week because the data is just too strong. I mean, look at the key inputs. We saw the second quarter GDP revised significantly upward. It posted an impressive 3.8% annual rate. And what's fascinating here is where that strength is coming from. It's driven by consistently strong consumer spending, sure, but also a significant broadening of non-residential investment.
Non-residential investment, so you mean capital expenditures, CapEx, but expanding beyond just the usual AI stuff, the chips and data center.
Exactly. We're finally seeing CapEx expand outside of that narrow focus, which, suggests real underlying strength.
So growth that's not purely concentrated in those tech mega caps, that implies some genuine systemic resilience. And that resilience, it seems, extends right into the labor market too, defying a lot of the slowdown forecasts.
It absolutely does.
Yeah.
Jobless claims fell to their lowest level since July. That puts a pretty decisive stop to any narrative that the labor market is weakening enough to warrant, urgent rate relief from the Fed.
Yeah.
Now, what does this strength imply? Well, the market had priced in about 150 basis points of rate cuts between now and the end of 2027.
Right, that was the base case for a lot of people.
It was, and that expectation has shrunk dramatically. Now we're down to just 100 basis points priced in.
Wow. So erasing 50 basis points to potential rate cuts over the next couple of years, that feels huge. What's the most critical consequence of just wiping out 50 basis points of expected easing like that?
Well, it fundamentally increases the expected cost of capital for years to come. That's the bottom line. When the market prices in less easing, it just means debt is going to remain more expensive for longer. Simple as that. So for corporations that rely on refinancing or, need cheap access to new funds for expansion, this shift hits their valuation models directly. It hits their future earnings forecasts. It's a signal that the era of ultra cheap money, which really fueled so much of the equity rally, it's just not coming back as quickly as everyone hoped. And for the near term, we've only got about 40 basis points priced in by the end of this calendar year.
40 points, so that reinforces the idea the Fed is probably done cutting until 2026 at the earliest.
That seems to be the message the market's sending, yeah.
Okay, here's where it gets really interesting, I think. How are the fixed income and currency markets reacting to this sudden fade in rate cut hopes and the higher expectation for long-term borrowing costs?
Well, we're seeing a pretty significant repricing in the bond market. As you'd expect, U.S. Treasury yields are trading at 3-week highs. The critical 10-year yield is hovering right around 4.17%. This move is fueled by general selling pressure, but also there's this growing skepticism from fixed income investors, the ones we often call the bond vigilantes.
Wait, hold on. If you don't mind, for listeners who maybe aren't deep in the bond trenches every day, what exactly are bond vigilantes and why are they wary right now?
Yeah, that's a great question. Bond vigilantes are basically market participants who sell off government bonds. They do it to protest or sort of express concern over what they see as fiscal irresponsibility, like really high government spending, Or sometimes it's just because they feel the yield they're getting isn't enough compensation for the risks they're taking. And they're wary right now because they're seeing a lack of demand in recent debt sales, coupled with this ongoing massive federal fiscal push. So they're essentially demanding a higher yield to hold that debt, and that pushes market rates up for everyone.
Okay, that makes sense. And that rising rate environment naturally strengthens the dollar, right? Based on the data, what's the US dollar index telling us, and how's it doing against its major peers?
Yeah, the fading rate cut story is a huge tailwind for the greenback. The US dollar index is sitting at a 3-week high right now, and that strength is especially pronounced against the Japanese yen. USD-JPY is trading perilously close to that critical psychological level of 150. It's currently at 149.82. Very close.
Wow, 150. That's a big line in the sand.
It really is. Intervention watch is definitely on there. The euro, though, is holding up a bit better. Euro ID is relatively flat, around 1.1667.
And you know, the strong dollar isn't just a number on a screen. It kind of acts like a miniature tightening mechanism all on its own, doesn't it?
Precisely. That's a great way to put it. A stronger dollar makes U.S. exports more expensive globally, and at the same time, it makes foreign raw materials cheaper for U.S. importers. But yeah, on the policy side, it is the tightening force. It counteracts some of the stimulus effects in the U.S. economy because it makes financing tougher for international entities dealing in dollars, and it tends to suppress U.S. import price inflation. Though it does add pressure to U.S. companies with big international revenue streams.
Okay, so that's the economic data and the rate reaction. Now we absolutely must pivot to the second massive pressure point hitting the market this morning. This tariff shockwave. The administration announced a sudden, really aggressive barrage of new protectionist tariffs, and they're set to take effect next Wednesday, October 1st. This just throws policy risk and trade uncertainty right into the mix when the market's already trying to digest the rate risk.
Yeah, this is a highly aggressive and kind of eclectic set of levies. It targets very specific supply chains. The most striking one has to be the 100% duty on branded or patented pharmaceuticals imported from specific regions. I mean, just to put that into perspective, that instantly doubles the price of certain drugs for the consumer or, the distributor.
100%, that's immense. But the source material we looked at highlights a crucial caveat here, one that immediately creates massive market divergence.
It absolutely does. That 100% duty comes with a key exemption. It is not applied if the pharmaceutical company is currently building or has recently announced plans to build a manufacturing plant in the U.S. And that single caveat turns what looks like a generalized policy risk into a highly localized, almost stock-specific opportunity or catastrophe.
Okay, tell us what else is included in this tariff package, and how is the market trying to sort of price in this manufacturing exemption thing, even when the details aren't fully clear?
Sure. So beyond pharma, we've got a 25% tariff announced on heavy truck imports. Then there's 50% on imports of kitchen cabinets and vanities, and 30% on upholstered furniture. So hitting housing-related goods, too. And the administration also announced sort of general plans to slash reliance on foreign semiconductor imports, which naturally created immediate anxiety across the whole chip sector.
And we can already see the market scrambling to figure out who qualifies for that pharma exemption, right? Like in European pharma, we saw stocks like Novo Nordisk and AstraZeneca drop sharply just because of the sheer uncertainty around that 100% tariff, even though AstraZeneca actually has announced U.S. plant plans, so uncertainty is trumping future plans right now.
Exactly. And look at the heavy truck sector for an even clearer example of this nuance. Daimler Trucks, which relies heavily on imports, fell substantially. Makes sense. Yet Volvo, which owns a long-established U.S. manufacturing base through Mack Trucks, actually rose nearly 2%. So the market is clearly using that exemption caveat as a direct predictor of who wins and who loses under this new policy regime, even when the policy itself is still pretty hazy.
It's fascinating how quickly markets try to parse these things, but despite all this drama in rates and policy, gold is still apparently set for its 6th weekly gain, and oil is heading for its biggest weekly gain. That kind of signals that while certain sectors are playing these specific policy games, the overarching sentiment might still be pointing towards elevated geopolitical risk, right? Risk off.
That's a really critical synthesis, I think. The general policy chaos, these sudden tariffs, the geopolitical tension we've seen simmering it, is driving investors towards traditional safe havens like gold and oil. It confirms that, the internal market fundamentals are battling some extreme external policy uncertainty.
Okay, speaking of battling fundamentals, given the macro strength we just talked about, strong GDP, strong labor market, why are U.S. equity markets actually struggling? The S&P 500 is posting its longest losing streak in a month. What gives?
Well, the internal health of the market is suffering, regardless of those headline economic numbers. If you look at market breadth, basically, the number of stocks participating in any move, it's terrible. The FINV's data we looked at shows that 70.8% of stocks are declining today. That severely outweighs the 25.8% that are advancing. So it indicates that the major indices, like the S&P, are being held up by just a handful of names, masking really widespread internal weakness.
Right, the generals are fighting, but the troops are retreating. And that weakness, particularly among some of those big tech names holding things up, brings us back to the massive AI infrastructure spending spree and the valuation of those few big tech stocks. This is precisely the concern that billionaire hedge fund founder David Einhorn highlighted recently, a warning about potential future capital destruction.
Yeah, Einhorn's warning is definitely one of the more sobering takes we found in the source material. He argues that the current really extreme build-out in AI infrastructure, all the data centers, the specialized chips, it may result in a tremendous amount of capital destruction, his words. And that could happen even if the underlying technology itself proves to be truly transformative.
Okay, let's dive a bit deeper into the mechanism he's describing there. He points to a potential circularity issue in the financing. How exactly does this circularity manifest in cash flow, and why is the actual monetization lagging behind all this infrastructure investment?
Right, the circularity issue basically arises because investors are pouring capital into the infrastructure providers. They're buying the chips from companies like NVIDIA, they're financing the data centers, but the actual monetization, the end user revenue from the services built on that infrastructure, it just hasn't caught up yet. So it creates this kind of closed loop. Investors are paying for the inputs, the picks and shovels, but the finished goods, the AI services themselves, aren't generating enough cash flow yet to justify that initial massive expenditure. And we've seen this movie before in previous tech cycles, haven't we?
We have.
And it leads to capital destruction when those infrastructure assets are ultimately underutilized or maybe become obsolete before they generate sufficient returns. The risk is simply that the infrastructure build-out happens way faster than true, profitable demand for the end services.
It really raises that uncomfortable question, doesn't it? How long can the market treat, say, NVIDIA's earnings results like they're a proxy for macro strength, before it starts demanding to see meaningful, diversified end-user profits across the entire AI ecosystem? That tension between the investment and the actual monetization feels like the biggest long-term risk to those sky-high valuations.
Absolutely.
Yeah.
The cycle continues as long as that faith holds, But the higher the amount of capital deployed up front, the higher the eventual risk of destruction if those profits don't materialize down the line.
Okay. We've covered the economic shock, the tariff shock, the AI valuation questions. Let's look ahead at the immediate risk events still scheduled for the rest of today, Friday, September 26th. We turn now to the investing.com calendar for the crucial data releases still coming up.
Right, the main focus this morning, released shortly after the markets opened at 8:30 a.m. ET, is the PCE inflation data, personal consumption expenditures. And this is crucial because it's the Federal Reserve's preferred inflation gauge. This is why we're watching the core PCE price index figure so closely, rather than just the headline number.
Right, and just quickly, could you remind us why the Fed prefers core PCE over, say, CPI or the headline PCE number?
Sure. The core PCE strips out the volatile components of food and energy. The Fed uses it because they feel it gives a clearer picture of the underlying, more persistent inflationary trends. Things driven by wages and demand for core services, basically the sticky stuff. Analysts were watching the estimates closely. 0.2% month over month and 2.9% year over year for the core reading. A hot print here, something significantly above those estimates, would immediately solidify that inflation reacceleration narrative we talked about. And it would likely permanently cement the market's repricing of those rate cuts we discussed earlier.
Okay, so PCE is the big one, data-wise. Then later in the morning at 10:00 a.m. ET, we get the Michigan Consumer Sentiment final reading. That'll give us a fresh look at how consumers are feeling amidst all this uncertainty. And then, importantly, in the afternoon at 1:00 p.m. ET, Fed Governor Michelle Bowman is scheduled to speak. Now, she's known historically for her more dovish leanings, right?
Generally, yes. Though she's been a bit more hawkish lately, like everyone else.
Right. But that timing is key, isn't it? It gives her a perfect platform to react directly to the morning's PCE data. She could offer immediate guidance on whether strong inflation indicators might change her view, perhaps shifting away from easier monetary policy if the data comes in hot.
Exactly. Her comments will be very closely watched for any reaction to that PCE number.
Okay, so to summarize this truly dramatic deep dive, what you're seeing is a market attempting a highly complex digestion process right now. We have surprisingly strong U.S. economic data that effectively cancels out those hoped-for rate cuts. And that's clashing simultaneously with the sudden spike in protectionism, including these immense 100% tariffs on key goods that threatens to reignite supply chain inflation, just as the Fed's most critical inflation gauge hits the wires. It's quite a mix.
It really is. And if we connect this to the broader picture, that policy uncertainty created by the political tariff chaos, that's one of the most significant headwinds right now, maybe even more so than the economic data itself, arguably. The sources we reviewed noted that we've already had 28 separate revisions to the U.S. tariff codes this year alone. 28.
Wow.
That level of frequent, unpredictable change makes it, frankly, mind-bogglingly complicated for multinational firms to accurately trade and manage their global supply chains. It forces companies to accelerate these pivot strategies, demanding resiliency, building in redundancy, often over pure cost efficiency. It's a huge shift.
So what does this all mean for you as you try to navigate this? Here's a final thought to chew on. If central banks are becoming so unpredictable because the data itself is so mixed, and if fiscal policies are creating such sharp, sector-specific risk through sudden tariffs, how should you adjust your own analytical framework for measuring true market risk? You clearly need to look beyond just the VIX, right? You almost have to start factoring in political decree, these sudden policy shifts, as an inherent and maybe constant variable of volatility. Something to think about. Thanks for watching. Don't forget to like and subscribe.